Well, the deregulation exists in the fantasy of her mind only. The problem with banking is that it's one of the most heavily regulated industries we have. It would be much safer if it was regulated by free market forces instead of government. It's government guaranteed bank accounts that are the reason that banks are so risk taking, because the customers don't care, because the government has already, agreed to guarantee their accounts. But, you mentioned earlier that we have record high credit card debt and the banks are failing. It's not a coincidence that both the borrowers and the lenders are broke. The reason for that is the Fed. The Fed kept interest rates artificially low for more than a decade, encouraging people to go deeper and deeper into debt and banks to extend them the credit. And now that they're forced to raise interest rates, something that was always going to happen, they have created another financial crisis, which is something I've been warning about for years. And the media is reluctant to call this a financial crisis. They keep saying it's a banking crisis. The financial crisis of 2008 was a banking crisis. Nobody wants to say what it is because they don't want to invoke memories and comparisons to 2008. But this is a sequel to 2008, and like all sequels, this one's going to be worse. First of all, the reason we had a financial crisis in 2008 was because from 2002 through 2005-ish, the Federal Reserve held interest rates at 1%, and that gave birth to the adjustable rate mortgages, zero doc loans, nothing down. In that era of cheap money, we inflated a housing bubble. And a lot of these real estate loans, predictably, and I predicted that, went bad when the Fed eventually normalized rates and they got them back up around 5%. And then we had a financial crisis. But the government cut it short with QE and 0% interest rates. But now we've had 0% rates for more than a decade. The Fed has made far more monetary policy mistakes since the 2008 financial crisis than prior. And so it has inflated a much bigger credit bubble. Now the banks are in far worse shape than they were in 2008, especially the two big to fail banks that we bailed out and are now much bigger than they were back then and even more insolvent. So as a result of what the Fed has done after the 2008 financial crisis, this new financial crisis that just got started will be much worse. And my fear, which is already being validated by last week's balance sheet, is that this crisis is going to be so bad that the Fed is going to pull out the stops and print as much money as possible to bail everybody out. And then the inflation that we saw in 2021 and 2022 is just the tip of a huge iceberg. And we're going to be looking at double-digit annual inflation rates really as far as the eye can see. Well, first of all, the banks haven't paid enough into the FDIC because they only have $100 billion. We have $18 trillion worth of deposits. And you know where that $100 billion is? It's already been loaned to the U.S. government because it's sitting in U.S. treasuries. So they'd have to sell the treasuries in order to bail out the banks. But there's not enough cash there because the banks haven't paid enough. And by the way, in 2008, the insured deposit limit was only $100,000.
Right, we raised it.
It was raised to $250, but we shouldn't even have the FDIC. It was created by Roosevelt during the New Deal in the 1930s. It was an overreaction to the Great Depression. Without any government insurance, with all the bank failures during the 1930s, only about 2% of the deposits was lost. The banking system was much sounder before we had an FDIC than it is now, because back then, banks had an incentive to be responsible. Nobody does any research. Does anybody care what the banks do with their money once they're deposited? No. And even the large investors or depositors, the people that had millions and millions of dollars at Silicon Valley Bank, didn't give a crap what the bank did with their money because they were pretty sure that if anything went wrong, the government would bail them out. And lo and behold, that's exactly what happened. No, of course, it's a bad call. It's doubling down on a bad policy. It's just going to create a bigger moral hazard, but they're trying to undo the damage from the moral hazard they created by bailing out some banks and leaving the impression that others might be vulnerable. Now they've created a run on solvent banks as people rush to put their money into insolvent banks. But of course, where is the government going to get the money? If they magically insure more bank deposits, that's just another unfunded liability that has to be piled on top of a massive unfunded debt on top of the funded debt that is unpayable already. So it's all going to be inflated away. That's what people have to worry about, that everybody's bank account is at risk because inflation is going to destroy the purchasing power of your money. It doesn't matter if your bank fails because the money that you've deposited in the bank, that's going to fail.